I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
After 3 extensions, the Reserve Bank of India finally put its foot down and implemented the tokenization norms effective October 1st. In September 2021, the central bank prohibited merchants from storing card information on servers and mandated a card-on-file tokenization. However, given the unpreparedness from all sides, the plan kept getting extended. Now that the rules are in place, all card data must be purged and tokenized. The measure is expected to cost merchants but increase customer security. Good morning, my name is Ishan Gera and you're watching the Business Standard Banking Show. In today's episode, we will cover significant developments of the week, including the takeaways from the latest monetary policy meeting. We have an interview lined up with Ugrow Capital's Vice Chairman and MD, Sachindra Nath. Given that the focus on the net liquidity in the system, our Banking for You section explains what a reduction in surplus liquidity means for the economy, and our banking expert Tamal Bandyopadhyay sheds light on RBI's policy and the future course of rate hikes. At the end of the episode, we shall discuss the poll for this week and ask you the question for the coming week. So stay tuned. Last week, the Reserve Bank of India raised rates for the 4th time in a row. After an off-cycle hike of 40 basis points, the central bank delivered 3 hikes of 50 basis points each. Market sentiment was veering towards a 25 or 35 basis point hike until a fortnight ago. Aggressive action from the US Fed and August inflation figures pushed expectations to 50 basis points. Besides increasing rates, the central bank also pared down growth from 7.2% to 7% and retained the inflation expectation of 6.7% for FY23. With hikes expected for the next 2 meetings of the fiscal, will RBI push rates into the positive real interest territory? Banks were quick in transmission as most major banks raised their deposit rates after the RBI announcement. The central government also announced an increase in rates for the small savings scheme instruments. However, most of the rates are still treading below the inflation rate. The expediency in raising rates on deposits is due to lagging deposit growth. Credit growth touched a decadal high of 16%, whereas deposit growth was just 9.5% for the week ending September 9th. It's good news for regional rural banks as well, at least for the larger and profitable ones. As per draft norms issued by the Finance Ministry, regional rural banks with a net worth of 300 crore rupees and above, capital adequacy of 9% in 3 years, and operating profit of at least 15 crore rupees in 3 of the last 5 years can list themselves. The Finance Ministry has also been coordinating with Indian Banks Association to bring RRBs at par with other players regarding technology. The number of regional rural banks decreased from 82 in 2010-11 to 43 today. Over the weekend, insurance regulator IRDAI issued a draft guideline on dematerialization of insurance policies. Comments have been sought from stakeholders by October 20th. The draft talks about setting up a technology framework. Claim servicing in such a scenario shall also occur using the online mode. The insurer shall offer discounts for policies purchased through the electronic platform. SEBI introduced the concept of demat accounts for securities in the late 1990s. It's not just banks which have witnessed stellar performance and double-digit credit growth. NBFCs are also experiencing a credit spurt. Business Standard's Manojit Saha had a conversation with Ugrow Capital's Vice Chairman and MD Sachindra Nath on the company's performance and whether the rate increase will dampen demand for fresh loans.
Welcome to the Business Standard Banking Show. Chokhani Securities was renamed as Ugrow Capital after Sachindra Nath, the former CEO of Relicon Enterprises, acquired the company in December 2017. Ugrow, a systemically important NBFC, commenced in lending operations in January 2019. It witnessed a year-on-year growth of 125% in FY22 to reach an AUM of close to 3,000 crore as on March 31st, 2022. To speak about the regulations around the NBFC sector and its growth opportunity, we today have Mr. Sachindra Nath, Executive Chairman and Managing Director, Ugrow Capital. Welcome to the show, Mr. Nath.
So Manojit, I think so if you look at our quarterly result presentation, I think so we are one of the unique companies which has put out its number, what we would do, not just for the current year, but all the way up to 2025. So our targeted asset under management by end of this year is slated to be 7,000 odd crore. As of September quarter ending, we should be around 4,300 odd crore, and hopefully we should reach that level of our business. And it is happening while you talked about the lower base, but I think so. One of the things which we have to remember, this is a company which started in July of 2018 with a straight 1,000 crore of capital raise, which came from some very marquee global institutional investor. We started our business in April of 19, and our first year was post ILFS, wherein we do 850 crore of business. Then we were halted for 10 months. In FY21, we were at 1350 odd crore, but during that period, we have grown our infrastructure. So from a 200 people, we went to 1,500 plus people, 8 location to 100 plus location. Our whole focus on data and technology has, taken leap-bound growth. And that's why from the 1,300 crore, we reached 3,000 crore in FY22, and now at 4,400, 300 crore in half year of FY23. And hopefully we should be at 7,000 crore, what we have already disclosed in public markets.
Right. But since interest rates are rising, do you think this could dampen demand for fresh loans?
So I think so the segment in which we operate, as we said that our whole premise is that data would transform the MSME credit in India. So it would reach to the level of consumer financing. We use our proprietary data tripod of banking, GST and bureau. Second, we operate the customer segment which are in the turnover band of 10 lakh rupees to 5 crore rupees. And all our 8 sectors and micro enterprises are consumption economy: healthcare, education, food processing, hospitality, light engineering. So our view is that the transmission of interest rate is not as high versus the credit demand and the need of credit for working capital and term loan. So we don't see that be a challenge. And also I think so the cost implication of the interest rate, a large portion of that is being borne by us, not by the end customer. So we are not seeing the fresh loan rates to go up. They are in the same band at what we were doing pre-rate hike and the post-rate hike.
But your cost of funds must have increased, because I mean, in September itself, we have raised NCDs at 10.5%. Are those cheaper than bank loans?
In the same band. As you know that we are technically a 3.5-year, 4-year-old company. And the liability side in India is divided in 2 parts. So you have, top 6, 7, 10 NBFCs, which are part of a large corporate group, wherein their cost of borrowing is linked to the parentage, versus company like ours, which are standing on its own basis, our, quality of capital, the governance and the management team. Our cost of capital would remain elevated in first 5 years, and it would gradually, basis portfolio performance, would come down, over a period of time. So in fact, we are seeing a gradual reduction in our cost of capital in a scenario where rates are going up. Is because of our vintage, and also because our initial cost of borrowing was much higher, and with the size coming, it is actually getting reduced.
Right, but I mean, is NCD is one of the should be preferred option going ahead, given the way bank loans are increasing?
So as you know that we look at our liability side. We say we are lending as a service. Our main source of liability is co-lending and co-origination. So if you look at a numbers slide, it would say that 35% of our assets are off-balance sheet asset, which is coming from our co-origination and co-lending side. So our view is that the on-balance sheet liability is much harder than off-balance sheet liability. And that's why UGRO is the largest player when it comes to the terms of co-lending and co-origination. Of the 12 public sector banks, more than 6 are now partnered with us. Private sector banks are there. Large NBFCs are our co-lending partner. In terms of the term liability, again, we look at every source. So we have 50 plus lenders on our balance sheet. We have now DFIs and impact fund, and public market and capital market is another source. So we look at diversity versus concentration, and every product has a different price band. So capital market listed NCD borrowing is while expensive, but we are establishing our brand and paying premium for that. Over a period of time, with rating upgrades and our vintage, that would also keep coming down. So we look at blended rate of capital versus byproduct rate of capital.
Coming to the asset quality issues, now many banks and other NBFCs are seeing stress in the accounts that were restructured during the COVID period, particularly from the MSME sector. What is the percentage of your restructured portfolio which is under stress, that is where repayment is due?
Yeah, so I think so. Look, I think so when the COVID hit and when we did the restructuring exercise, we were given that we were focused on sectors. So we were focused on healthcare, education, hospitality, light engineering, electrical equipment manufacturing, auto component, chemical, so on and so forth, and 100 subsector. We did a mortality exercise. For all of our 8 sector and 100 subsector, we did a mortality exercise. So for example, in hospitality, mortality rate for banquet hall was 100% versus fast food chain was 10%. And we allowed restructuring only for businesses wherein we felt that the post-COVID, the revenue pickup would happen. But otherwise, we felt that restructuring an account which otherwise cannot survive doesn't serve the purpose. It put pressure on our balance sheet and also actually killing the MSME itself. So that's why we curtailed the restructuring and we did not use it for all. Today, our total restructured portfolio is roughly around 3.5%, and almost 90% of that portfolio is current. So within the hospitality and very small restaurant business, which were unsecured, roughly around 10 odd crore of portfolio, which is under stress, and we think so would not come back, because once a small restaurant has shut down, it is very difficult for that to revive. Somebody else.
Correct.
Places that.
Correct.
I think the rest of our sectors have come back very strongly.
On that note, Mr. Sachindra Nath, it was a pleasure talking to you. Thank you for speaking to Business Standard.
Thank you so much, Manojit. Thanks for your time.
Thank you, sir. Thank you.
Ugro Capital extends loans to small businesses and MSMEs. Nath says the target AUM by the end of this fiscal is 7,000 crore rupees. The company has grown from a 200 people to a 1,500 people company. Even though Ugro is flush with liquidity, the system is not. Net liquidity in the system went into a deficit for the first time in over 3 years. But what is liquidity and what does it mean for the economy? Our experts explain in the Banking for You section.
A key development in India's banking system over the last month is a significant narrowing of surplus liquidity. The phenomenon has widespread implications, as maintaining a vast liquidity surplus by the RBI during the COVID-19 crisis was a critical factor that kept borrowing costs anchored in the economy. With banks no longer flush with the same degree of excess cash as before, financial conditions have become tighter, leading to a rise in short-term money market rates and related borrowing costs. Amid a 9-year high growth in credit demand, banks are compelled to mobilize deposits and fund the credit growth as surplus liquidity has shrunk. Lenders are not only offering higher rates on deposits but also shelling out more to raise funds through certificates of deposits. Let us dwell into how exactly the liquidity landscape has changed. When the COVID-19 pandemic struck India in March 2020, the RBI embarked on an aggressive monetary easing cycle. As a part of this, it infused large amounts of cash into the banking system by purchasing government bonds held by lenders. It also provided options for various kinds of repo operations for banks and access funds at a low cost. Large overseas fund inflows also increased rupee availability in the banking system. The RBI's steps ensured that access to credit was cheap, with money market rates remaining below the policy for much of the pandemic. Core liquidity, which is liquidity in the banking system plus the government's cash balance, was over 10 trillion rupees at the height of the COVID-19 crisis. The daily liquidity surplus has shrunk to around 1 trillion rupees, much lower than 7.5 trillion rupees in March. Last month, there were episodes of liquidity slipping into deficit and banks paying a penal rate to borrow funds from the RBI. This has occurred by RBI's design. It has sold government bonds to banks as well as due to factors such as the high credit demand and the central bank's sales of dollars to protect the rupee. Given that the RBI is tackling high inflation through rate hikes, it is no longer comfortable with excess liquidity, which poses inflationary risks.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve. I will fly high. In SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The RBI governor seemed calmer about the liquidity conditions than most analysts and markets. The markets were also calm given that they had factored in the extent of the rate hike. Our banking expert Tamal Bandyopadhyay decodes the monetary policy meeting and also charts out a future course of action for the central bank. Hi Tamal, thanks for coming on the show.
Thank you.
Now you were bang on the RBI policy, the three fronts that you mentioned. You were right there, the 50 basis point hike, the inflation not being changed, and the growth being pared down. It was as if you were right there with the policy. Now you are predicting a 35 basis point hike in the next December meeting. What about the 35 basis point forecast for the December meeting? What is your rationale for that?
Well, as you have noticed, Governor Das, unlike many other central bankers across the globe, has refrained from giving any forward guidance. He has said it would be data-driven. Indeed, it would be. But if you read between the lines, in his interaction with the press, he disowned the word front-loading. He said, I have not said that. Some MPC members have said that. And second part, again, if you look at the governor's statement, he has gone back to June 2019. What was the level of inflation and what was the interest rate at that point of time? I'm reading out there. When retail inflation was 3% and expected to rise 3 to 3.7%, the RBI policy rates were 5.75%. Now you have a retail inflation of 7%. So how can you have 5.9% rate? I mean, he has not mentioned about negative interest rate, but clearly hint is very clear. It's elementarization. There's no escape from rate hike. So I would like to believe whether it's 35 basis point or 25 basis point, that's a matter of debate. We don't know. I think as we move, there will be a rate hike for sure in December and probably 35 and yet another in February 15, so 25 basis point. So 5.9 to 6.25 and 6.5. That's a sort of terminal rate. I think 6.25, between 6.25 and 6.5, we would see the rate, policy rate before the end of the fiscal year.
Even with that, we are in a negative real interest territory. Do you think RBI will try to alter that situation in this year?
No, I think it's not in India at all. If you look at the globe, I can't think of any country offhand where interest rate is positive. This is one of the unprecedented scenario where across the globe, across the countries, you have real interest rate negative. So India is no exception. I would like to believe we are probably marginally better off from some other countries, definitely better off from most of the emerging markets.
RBI governor somewhere said that 67% of our reserves had come down because of the depreciation there. What is the position on our forex?
Well, that, I think you need to do arithmetic in this way. Our foreign exchange reserves has gone down by about 100 billion over the last 1 year, between last September and this September. Now, what are the components of foreign exchange reserves? One is foreign exchange per se. Second is second is gold. Third is SDR. And fourth is the money kept with IMF, which is far higher than rupee. That has contributed because to that extent, your dollar reserve would depreciate. Second is gold. The price of gold has come down. So that has contributed to that. And the third factor is the M2M loss, which the bank treasury does. When the yield rises and the prices go down, you have to market your portfolio. So Reserve Bank of India's investment, so if 60 or 65% of its foreign exchange reserves, I mean the currency reserve, belongs to dollar, this dollar, the RBI does not keep it in its safe vault. It's invested, right? So when the price is going up, price is going down, and yield is going up, as you know the story in US. So certainly you need to book M2M losses, and to that extent your value gets eroded. So it's a combination of all these factors.
Yeah, I'll veer you towards another point that you mentioned in your column, but don't expand on it much. One, that is the liquidity front. The RBI governor seemed calmer than the markets and most analysts. Is there a need to worry on that front because credit growth has outpaced deposit growth?
On the liquidity, you have to see liquidity. You can see liquidity in different prism. One is this: you see the liquidity in every or what is not available to banks, but it is there, like the government, the money of the government, etc. If government starts spending, it will come out in the system. And other is you just see the net liquidity. You are right, at this point of time, the net liquidity is much lower, and on some days, which is zero or minus, that's the case. But RBI governor is hopeful because the government's position is pretty good on the fiscal side. I think there's not much of worry in the sense the direct tax collections is good. So he expects that government will start spending, and that will add to the systemic liquidity. As far as banks' deposits are concerned, you are right, because as we speak, credit growth is 16% plus, which is a 9-year high, and incrementally, credit deposit ratio is, I think, about 112%, 112 odd, which means for every 100 rupee deposits accretion, new deposit accretion, banks are actually giving credit 112 rupees. Now, where is it coming from? It's coming from their capital, right? Or because you don't borrow from market to build your loan assets. Borrowing from market is just to take care of temporary asset liability mismatches. So the banks have no choice. I repeat, banks have no choice but to raise their deposit rate.
Thank you. Thanks a lot for coming on the show. We hope to see you back again next week. Thank you.
Thank you.
Tamal believes that rates may go up to 6.5% by the end of the fiscal and predicts a 35 basis point hike in the December meeting. That is not the consensus from our poll though. Last week, we asked you if RBI should be more aggressive as regards its rate hikes. 59% of the people said yes, whereas the rest disagreed. Although growth is not a concern for the central bank, an aggressive stance of front-loading of rate hikes will surely dent growth prospects. The Fed raised rates by 75 basis points just a fortnight ago, and the ECB did the same. This week, we want to turn towards an issue that is expected to pinch both merchants and customers in the short run. As tokenization is the talk of the town, we would like to know if RBI should have given more time to merchants for tokenization. The deadline was already extended by 10 months. Our polls open on Friday, and you can respond on our website, Twitter, Instagram, LinkedIn, and Telegram. Last year, after RBI had changed norms for automatic renewals, there was a flurry of card declines. Whether or not we are in a similar situation this time shall depend on how well equipped banks have been to handle new changes. We'll be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.